Hello traders, so in this lesson, we're going to cover liquidity sweep plus inducement. So before we start, we need to understand what liquidity is. And I know I've covered this in plenty other lessons, but in case we have any new students here, we're going to go over it real quick. So let's start off with what a liquidity run is. We'll keep it really quick. So as you can see here, there was a rejection. What does this rejection tells us? This tells us that business was conducted at this level. The price couldn't break this level and sell orders came in, which means that this is now our liquidity. This is where the orders are resting. So when price does come back to this area and runs through it, this would be called a liquidity run. Now, on the other hand, what we're mainly going to focus on will be our liquidity sweep in this lesson. And here's the difference. As you can see here, your liquidity has been engineered. These are your equal highs. And now that price breaks out of this range, instead of continuing to the upside, price will return back inside of the range, which will form our purge, which will be our liquidity sweep. So think of liquidity as somewhere where business was conducted. So let's say you have your swing right here and price came back to that swing and rejected. What information does this tell us? What does this tell us right here? That when price reached this level, price rejected from this level and dropped down. So this tells us that there were sell orders here. So not only did sell orders came in here, a lot of retail traders sold here and their stop losses would be right here. This is why we consider this level as a level of liquidity. So even if they didn't sell at this point, let's say they sold at this point, this is where their stop loss would be. So when price does approach this area, it will more than likely actually completely cross this area and take out the liquidity. Now price could continue and have your liquidity run, or price could reverse and come back in the range, forming a purge. So here's an example of support and resistance liquidity. As you can see here, rejection has been formed, and now this level is attracting price like a magnet. Before you proceed, please make sure you like the video and leave a comment. This video is completely unmonetized to make sure you guys are not interrupted by ads. So now that you understand what support and resistance liquidity is, let's take it a step further. So let's say you have a swing right here and you have another swing right here. So now what is the relationship between this swing and this swing? Again, they're not equal, not even relatively equal. So what is the relationship? The relationship here is that this swing right here, your second swing, is a reaction from your prior swing. This is a reaction from a more than likely an order block or more than likely just a supply level. So let's say a supply order block. This is a reaction. And what does this tell us? That not only institutions bought here, after you see this reaction, a lot of retail traders would have purchased here, would have purchased here, would have purchased here, and so on. And their stop losses would be right here and right here. And this is your nearest liquidity level. So how can you use this information? You would mark this swing. And when price approaches this level, you know price will more than likely not find a rejection from an internal level right here and drop down. This will more than likely not happen. If price does get in your premium level right here, price will more than likely take this level over. Now again, price could continue higher, or price could simply just come up for a liquidity sweep and come down. So what is inducement? So let's say you have a swing right here. And in this case, let's say your entry is right here. You have a supply order block. And let's say prior to this, the trend was bearish. And you're looking to take price down. And your entry is you're waiting for price to get to this level. So what an inducement is a trap. It's a trap for retail traders. So let's say this level is the level of interest. And even for institutions, it will be cheaper to move price at this level, which I will explain in the next chapter. It will be cheaper for them to move price, and they know they're going to drive price to this level, but they can't just give the retail traders an easy entry like this. They will try and pump fake you. So let's say they would form something like this. Price will come up here, close to your point of interest, but reverse. So what would you think as a retail trader? You would think, okay, price is not reaching this level is nullified, and this is our new target. Now this is our new target. So now when price breaks structure, you're like, okay, this downtrend is continuing. Price comes back and wants to approach this level, and you're taking your entry here. You're taking your entry here with your stop loss a little bit above your level, and you're trying to take price down because you're following the supply and demand structure. But what happens is price will take this level out, attack the original point of interest, and return and continue the bearish trend. So it takes you out of your entry and then continues. So what happens here? This level is your liquidity now. This entire level is your liquidity. Why? Because this was the inducement. The sole purpose of an inducement is to induce traders into taking an early position. And this is where your liquidity sweep happened. So here's an example of combining inducement plus your liquidity sweep. So as you can see, this is your point of interest. This is the entry you're targeting. But here is your false swing. This is your inducement. This is your trap. So when price does approach this level, it targets the initial point of interest and reverses. So now this is your liquidity sweep. So again, this right here is your inducement, and this is your liquidity sweep, which is your purge. So here's another variation of your liquidity sweep plus your inducement. And in this case, we're going to cover the support and resistance liquidity. As you can see here, you had a support and resistance rejection, which formed your equal highs. So now price attacks your point of interest and reverses, forms your liquidity sweep, which is your purge. So as you can see here, you have your demand order block, which is your point of interest, and you can see the liquidity being engineered. The trap is being set. Price is rejecting from this level, trying to induce traders into taking an early position, and price will attack your demand order block before expanding. So how can we add more context to this? Let's say you have your swing that you're targeting. Let's say this is the swing that you're targeting, and this is your point of interest. How can we make sure we get the perfect inducement? So what you do is you pull out your fib and you guarantee your range. So the way you lock in your range is look at the previous. So this was your previous low prior to breaking the range, and price broke this low and came back inside of the range. So once price came back inside of the range, as you can see right here, price broke this low and came back inside of the range. Now this is your new low. So now this is locked as your range, and your high was this high right here. So this is your range. Simple. This is your range. So now you pull out your fib. And what are the levels of this fib? These are the levels: 0, 25, 5, 75, 1. And let me explain this really quick. This fib is a representation of your extreme levels, right? This here is your premium. And this here is your discount. And I have a whole lesson on premium discount. All you have to do is go on YouTube and look for ETM effects, premium and discount. And the way to look at it is premium, it'll be cheaper to sell price at the premium level, at the highest point. And it'll be cheapest to buy price at the discount. So buy low, sell high. Buy low, sell high. So let's say this is your range. Let's say this is your range right here. It'll be cheaper for the institutions to purchase price in this area and sell price at this area. So again, it'll be cheaper to buy price at this area and cheaper to sell price at this area. So now that we have our levels, what we're waiting for now is for our inducement to happen before reaching our premium level. What we don't want to happen is we don't want our inducement to happen right here and then for price to attack our point of interest. Why don't we want this to happen? Because there's a certain amount of orders in our premium. This is where it's cheaper to sell price. So if price already attacked this level once, twice, the third time, it can more than likely continue above and the sweep does not happen. And what we're waiting for that sweep. We're looking to trade that liquidity sweep. So what we are looking for is for this inducement not to happen in our premium zone, preferably for the inducement to happen somewhere right here. This will be the highest probability. So if our inducement happens right here, we're waiting for price to attack this level and lock in our sweep. Now, if it doesn't happen in a fair price, which is our middle ground, it could happen somewhere around here as long as it does not make contact with our premium level. So what we would be looking at is for price to come up, form a trap, whether it's a equal high trap, or it could also be a internal trap, which could be your fake swing right here, or it could very well just be one swing. Price come up right here and drop down, forming your fake supply zone for price to later do what? Come up, take this level, attack your initial point of interest, which is in your premium zone, and drop down. And when that happens, this is where your liquidity sweep / purge occurs. And when you remove the fib, you can kind of see it clearly. This was your liquidity, this was your sweep, and this was your premium order block in your range. So what do we have here? We have a major break of structure. So you have your swing high being broken here, and this is your previous low, and we are in a uptrend. We are in a bullish trend, just how I explained in my previous lessons. As far as your liquidity sweep goes, we are in a uptrend. So what are we waiting for? We're waiting for price to come back inside of the range. And once price comes back inside of the range, we can confirm a new range. So let's see. So now price came back inside of the range. So now this is our high and this is our low. So now this is our range. So now we can pull out our fib and mark our premium and discount level. So this is our discount level that we're simply targeting, and there's no point of marking our premium level for this example. Why? Because we are on a bullish trend. If we're in a bullish trend, we're strictly trying to buy price. And let's mark our 50% just for context. So now that we have our levels, what are we waiting for? We are waiting for inducement to happen. But how are we waiting for inducement to happen? We need it to happen away from our extreme zone, which in this case, our discount, which aligns completely with our discounted order block. So we are waiting for this to occur away from our discounted order block. So let's see. Okay, so we have our swing. Let's mark our swing. And this now is our inducement level. So let's put a $sign under. And what are we waiting for now? We're waiting for price to take this level out and have our liquidity sweep. And our entry is obviously our order block. So this is the trap. This is our inducement. So let's see. Price is rejecting from this level, forming our equal lows. And what context do you have previous to that? Price broke structure, came down to an extreme level, to our demand level, and expanded again. So now if price breaks structure right here, we have to shift our point of interest. So if price breaks this structure level right here, we would have to change our point of interest. Let's expand this. Price is still rejecting from this level. What is this doing to the retail trader? It's inducing the traders to take a buy. So you have your retail traders taking a buy here, taking another buy here, and so on, multiple different positions, depends on the level of a trader. What smart money traders do, we just sit there and wait. We wait for the retail traders to get trapped and get liquidated for us to take the correct entry. And here is our rejection. Once price comes back inside of previous range, this is now our liquidity sweep. Price liquidated all the traders, all the retail traders, and now price will continue with our initial bullish trend. So as you can see here, look for how long price was trying to trap retail traders. This entire purpose of this consolidation and rejecting from this level was for this sweep to occur. Make sure you guys hit the like button. If this video gets over 1,000 likes, I'll make a complete strategy video on liquidity sweep, what time frame to use, when to trade it, what approach is the best, and cover every aspect of the strategy.